Hi friends, so today we are going to see how to calculate the profitability and stability ratios of the company by using the balance sheet of the company in conjunction with the profit and loss statement of the company. So we are going to continue building on the previous Excel sheet which we have used in profit and loss statement. There we had identified a few ratios. So we are going to further on improvise on that Excel sheet itself to derive further ratios which we can use to filter out our great companies. So now let us see the annual report of Colgate Palmolive. Let us quickly jump into our balance sheet. This is the balance sheet for Colgate Palmolive for the year 2022. As you understand, balance sheet shows us the balance of what the company owns in terms of assets and what the company owes in terms of equity and liabilities. Equity and liabilities is used by the company to raise funds so that it can buy its assets. So here we see the balance sheet of Colgate Palmolive. The first section is the assets, and the second section is the equity and liabilities. So both the sections have to balance out. So the total assets, let us see what are the total assets. And then let us also mark what are the total equity and liabilities. Let us see if they indeed balance out. Yes, they do balance out. 290,183.14 and 290,183.14 against total equity and liabilities. So the balance sheet does indicate that they do balance out. Now within the asset, let's see at various aspects, various line items within the asset section as well as the equity and liability section as we go through this session. So the first section within the asset is our non-current assets. Non-current assets are assets which the company will be holding for a period more than a year. And current asset is what the company is planning to liquidate in a period of 12 months itself. So now let me bring out a different highlighter and show what are the parts of the non-current assets. So within non-current assets, you have property, plant, and equipment. So the total value carried by this property, plant, and equipment is 96297, and the details can be found in section 3A. So let us go quickly to 3A. So as you know, property, plant, and equipment are physical in nature, and the useful period where this will be used is for a long duration of time. Hence, these assets will be carrying depreciation every year on year. So here we see how the company has calculated the depreciated value over a course of time. So here we see the gross carrying amount, which was the initial amount carried by the particular asset, and how much depreciation has been applied over a period of years. Then finally, in 2022, we see then the net carrying value. This is the value which the assets hold as of 2022, that is 96297.14. 143,777.98. This was the accumulated depreciation over a period of time. It has depreciated, and hence this is the total value which has depreciated. So hopefully within a couple of years, the value, net carrying value, will be zero for Colgate Palmolive. Let's see in our subsequent years later on. So now that we have seen the property, plant, and equipment, let us go into capital work in progress. So this capital work in progress is what the company has invested towards creation of long-term assets. Now this capital which has been invested may have been aging since 1 year, 2 years, 3 years, whatever it might be. But it is the capital which has been invested for creation of long-term assets. Hence, it comes under non-current assets. And details can be found under section 3B. And the value carried is 12,184.42. Other intangible assets, there is no value for Colgate Palmolive. Then you have financial assets, as I've explained in the previous videos as well. Financial assets are basically what the company does investments on. These are long-term investments. There is loan which it has provided, and there are certain other financial assets. So investment, let us go into note 4 first. Here we get note 4, long-term investment, non-current investment. These are investment in bonds for power finance. We see here 2 entries of power finance, and the total value carried is 1861.45. So this is the value which we should see in our balance sheet as well. Oh, we don't see any value. So let us go back into our notes. Note 4. Probably we made a mistake by looking into it. Right, there is no value. I mean, in 2022, there is indeed no value. It was the value for the previous year, 2021. Okay, great. We just made a mistake anyway. So we are back on 140. Loans. Now the loans which the company has as assets is given in note 5, 133.88. This is the total loan that the company has provided to another person or maybe some organization. The details can be found in note 5. So these are non-current loan, long-term loans. So basically the company has given loan to its employees, 133.88. Okay, lucky employees. So then we have notes ticked off. That was the total amount which we have seen, 133. And then we come to others, which is 1703.29. And this is note 6. We'll go to quickly to note 6. Yes, indeed, note 6, 1703.29. That was the value which we have seen. Basically, these are deposits with the banks having a maturity period of more than 12 months. It is already clearly stated here. So this may be fixed deposits or small savings probably. So we go back to 140, our balance sheet. So we have covered others. Now we go to our deferred tax assets. So what is deferred tax assets? So deferred tax assets is what the company has paid towards taxes in excess in the previous year. So because it has paid in excess, this finally become as an asset in this year. And it also has few other current tax assets, probably due to leases and certain exemptions. So which is covered under section 32D. So this can be looked up into details in section 20 and 32D. Then we have our non-current assets, other non-current assets. The value is not so much, but not too less either. 972.62. Let's go to our note 7 out of curiosity. Note 7. Here is the other non-current assets. Here are certain capital advances which the company has given, certain deposits with governments and other authorities, and certain prepaid expenses. Okay, so these are the classification within other non-current assets. And next we go to our current assets. Within current assets, we have the first item, that is our inventory. Inventory, here we go. So the inventory basically indicates assets which were not yet consumed. It was able to generate inventory, but it was not able to sell it in the previous year. So this could be in terms of spares, it could be in terms of finished goods as well. It could be in terms of certain capital which is invested, but it's in flight. So let us go and quickly see what is there within note 8. So note 8. So these are certain raw materials, raw and packing materials which you can see, and certain other items as well. That is certain items towards finished goods, certain stock in trade, work in progress. So the total amount comes to 35718. So this is the amount which you should see. 35718. Great. So now we go to our financial assets. So what is financial assets? The first one within the financial asset is our trade receivable. So as the name indicates, the company has given or sold products to certain maybe retailers for which it is expecting revenue back from them. So this is the revenue which it is expecting back. So this is the revenue for which it is expecting in terms of cash. It has made the sale, but it has not yet received cash. So we can go into this note 9. So note 9 gives us the detailed breakdown of the trade receivables. We have all these items here. It has two parts of breakdown. The first is the trade receivables and how much receivables and how much it is doubtful to receive. As you see here, there is less allowance for doubtful debts. So these are the debts probably it may not recover from its retailers. After adjusting all these bad debts as well, this is the amount it has arrived to 467.81. So it has used a different classification in the next section, unsecured and considered good. Though it is unsecured, that means it has not taken any guarantee for these particular assets. So hence it is considered unsecured, but due to goodwill, it is considered good. And trade receivable, which has significant increase in credit risk. This is 682.68. There is certain credit risk, but that's fine. Hence, I guess it is adjusted as allowance for doubtful debt, which is 682.68, and this is the value it has arrived to 468.81. So we go back into 120. This is the value which we have seen. So next we come to our cash and cash equivalents. Let me use a different highlighter. Oops, it's picking up a different whatever. Then I will get back to 140. Sorry about that. 40. So we have covered trade receivables. We then go to cash and cash equivalents. Cash and cash equivalents is 72406. And then you have bank balances, which is 3064.63 crores. So both these combined are basically deposits made in the bank. They may be fixed deposits or other short-term deposits. So basically they are current assets and they are short-term in nature. And then it has loans, certain loans which have been provided or which it is expecting back. But however, these are short-term loans. The value is 1073.91. Let's see to whom it has given the short-term loans. Note 10. I guess it was not note 10, it was note 12. That is our current loans. So this current loans, it has a value of 10,731. That was the value which we have seen. So this was loan to the employees. Great. It is expecting this loan within a period of 12 months. And intercorporate deposit, this also is expecting that within a period of 12 months. So now that we have seen loan, we can similarly see what is constituted within the other and other current assets as part of the respective notes. So now that we have covered the asset section of the balance sheet, let us see into our equity and liability section. Within equity and liability, the first section is equity. And the first item within equity is equity share capital. This is the capital which the company has received towards its investment. That means the promoters, whatever the promoters have put, and via the IPO process, whatever the company has able to raise from the market. So this is shown as equity share capital. Next comes the other equity, which is the reserves and surplus. This is the capital which the company accumulates over a period of time. So whenever the company earns profit, this profit can be catered all towards the reserves and surplus, or it can divide this profit into reserves and surplus and continue accumulating it, and other percentage of the profit it can give it as dividends. And then the summation of both the items, that is equity share capital and other equity. This is the total equity. So next comes the liability. So liability also has non-current liabilities and it has current liabilities. So non-current liabilities, what a company has as loans, liabilities towards third-party organizations or institutions, for which it is likely to pay it out within a period of more than a year. And current liability is expected to wind it up within a period of a year itself. So within both non-current liabilities and current liabilities, you have financial liabilities. And we have already seen what financial liabilities is as part of the assets. So equivalent financial aspect which is an asset to somebody, becomes a liability to Colgate Palmolive. But one particular item which we need to definitely look into is our trade payables. Trade payables is what the company is expected to pay back to its suppliers. And if you see this amount, it's quite a huge amount, 75, and then 1556, and then another amount 3519.28. If you compare trade payables versus trade receivables was only 22,467, but trade payables is almost close to around 80,000, almost like 3 to 4 times of trade receivable. This indicates that the company has a strong bargaining power towards its suppliers. That means it's able to negotiate its terms and conditions very well with its suppliers. And hence, it is able to hold this cash back with itself and maybe invest into fixed deposits or any other investment it seems suitable, and it did not pay back this amount in maybe whatever terms and conditions it might have with the supplier, sometimes a month or 3 months. Within this period, it can gain significant interest payments as well. So this was one aspect which I wanted to show as part of equity and liability. And all the other aspects are one aspect which we haven't seen is the provisions. And you can see provision as part of non-current liabilities as well as current liabilities. So let us see our note 21. Note 21, these are other non-current liabilities. These are payable under voluntary retirement scheme. So on the voluntary retirement scheme, this is the amount which the company is liable to pay. And then we have note 25. I guess it just went by. Note 25 is part of a current provision. That means for a period of less than a year. That means this is expected to pay provident funds to the employees. Compensated absences also it's supposed to pay, and certain other statutory liabilities. The details are given in note A and other matter in note B. So these are the liabilities which may be some contingency liabilities. It is expected to pay back. So 8401.83 is a current liability, current provisions. So if we go into current provisions, so we see current provision 8401. This was the large amount, that's why we remember. And the non-current provision was a very small amount, 45.12 is what we recollect. So now that we have covered the balance sheet, we have understood each and every line item within the balance sheet. We have seen how to read the details of each and every line item of the balance sheet again. So in case you have certain comments or certain queries, you can please drop in a note if you weren't able to understand certain aspects, or I might have skipped certain aspect because it was quite obvious from the asset section. Hence, that was the reason I skipped. But however, if you weren't able to understand, maybe I should do another video highlighting each and every section in detail, or maybe have a Zoom session with you if in case you need certain help. So now that we have covered detailed analysis about balance sheet, let's get into our ratio analysis. So for our ratio analysis, let me open the Excel sheet. So this is the Excel sheet which we have seen in a profit and loss statement analysis. And today we're going to see the balance sheet. I've shown last time on how we can take the values from moneycontrol.com. So I have picked up all these values from moneycontrol.com within a click. So equity and liabilities I filled the asset section. All the line items I have made equivalent line items in the Excel sheet as well. And then after this, I have calculated few ratios. We'll understand all these ratios, and then I'm going to tell you which are the key ratios which I use for filtering out my companies. So the return on equity, this is the net profit earned over the equity. So the numerator is the net profit, that net profit we get from the profit and loss statement, and the denominator is the equity of the company. So let us take the net profit of the company. We have seen for this particular year, consolidated net profit 1078. And then the denominator is the total equity. So total equity, as we see here, is the shareholder net worth 1735. And then if you divide these two values, numerator divided by this value, we get 62%. So this same formula, we see the values here as well, 62%. Let me reduce some column. So we see the values matching. Then we see the return on capital investment. So for returns on capital employed, we take the operating profit of the company. In case you want to know why we take operating profit, please drop in a comment and I will get back on a separate video explaining why. So for now, just to understand how it is calculated, we take the operating profit from the profit and loss statement. Is the EBIT 1389. Then we have our denominator, which is our total assets, or we can have total equity plus liabilities. Anywhere you can choose because both will match. So we pick up total assets. This we divide by the denominator. It will a percentage. So see the percentage which is matching. Next we see how we calculate the debt by cash balance. So basically, whenever I take loan, I try to see how much cash balance I have, so that in case required, I can pay back the entire loan within a period of 2 years max. So in case of companies, I try to see, how much cash balance it has. Is it able to pay back that whatever long-term debt it might have? So for this, I picked up the non-current liability. So this is the latest non-current liability, and the cash balance it holds on its books in the bank. Cash balance is here. The same percentage. So if you see here, the debt is not much, so we can immediately pay back its debt from the cash balance whatever it has. So fantastic. This is not a ratio commonly used, but however I use it for my own analysis. Next is our long-term debt to equity. So the long-term debt to equity, this we calculate by taking the non-current liability of the company, which is the same value, 85. Non-current liability, 85. And then we take the total equity of the company. Total equity plus liability. So value calculated as 3%. So I need to also correct this as total equity plus liability. So this is basically total equity plus. So this is the value. Now they both are matching. So I take this value and copy paste to all other years as well. And this is the amount I get. I click the percentage. So after we have calculated total long-term debt by equity, we then check what is the ratio of trade payable versus the trade receivable. Ideally, I would expect trade payables to be higher than trade receivables, and the average for Colgate Palmolive is 4.1. So basically, that's the division. You just take the trade payables. So I quickly take the trade payables. Trade payables will come as liabilities and divided by trade receivable. Trade receivable comes as assets. This is the so here we see the value 3. If I expand this value 3, it comes to 3.4, which is matching with this value. 3.4 is matching with 3.4. So finally, we get corresponding values. The value which I have corrected due to this particular video is long-term debt and equity. As you all know, I'm building this Excel as we go through our discussions. So now let us see at the key ratio which I use. The key ratio which I use from balance sheet analysis. The first ratio is a return on capital employed. The second is the debt by equity. These are the two important ratios which I use for filtering out great companies. So the reason it is showing in green, the benchmark which is used for ROC is 16%. Anything greater than 16% is a sign of a great company. And the debt to equity, that should be less than 10%. So in case of Colgate Palmolive, it is much lesser than 10%. And of course, there are additional ratios which I've calculated, which will be as I pick up companies, I can have a look at other ratios as well. We don't know what ratio might trigger, a bulb. Then finally, we have our growth checklist. The growth checklist, I picked up net profit and revenue from the profit and loss statement. And then I've taken up the growth checklist of net worth of the company, that is our reserves and surplus. And then the cash, how much cash it is growing, and then the long-term debt for the company is taking. So it is worth taking a note here that the net worth has grown by 3% for Colgate Palmolive, and return on capital employed has grown by is actually 42.1%. It does indicate that the company is not retaining a lot of cash, and hence it is showing net worth increase of only 3%. And because it is not retaining any cash, it is resulting into a higher return on capital employed. But nevertheless, it is paying out dividends to its shareholders, and hence it's a good sign. It depends on what the company is expecting to do with its cash. So these are the list of parameters, and then I've also plotted a chart of all the parameters, so you can see, have a look how is the performance with respect to the previous years. If you see ROC, there's a slight dip. If you see return on capital employed, it is pretty much stable. So this is one of the value which I see, and the stability and a slight rise is a good sign. Debt to cash balance, this is on a dip, and the next is the long-term debt to equity. This is also a slight dip, so which is a good sign. So it's a great company to invest. It is managing its finances quite well. Well, I'm not promoting it. It is just taken for illustration. I am a shareholder of Colgate Palmolive. Let me admit it again. So next, we will look into our cash flow statement. So I will discuss about cash flow statement in our next video. So until then, see you. Bye.